Ford Motor Co. is currently trading at $11.92, down a significant $0.78, marking a 6.14% drop in today's session. Now, the immediate reaction to a drop like this is often visceral. The headlines will scream about investor panic, concerns over EV production targets, or maybe another macroeconomic headwind. And while those factors are certainly part of the picture, the reality of what's moving Ford's stock today is far more nuanced and points to a deeper recalibration of expectations within the automotive sector. The market is processing not just Ford's individual story, but a broader, sector-wide narrative about the true cost and timeline of the electric transition. That 6% decline isn't just about a bad day, it's a reflection of a painful but necessary dose of reality setting in for investors who believed the shift to EVs would be a smooth, linear progression. Many traders using platforms like Robinhood or SoFi Invest might see this as a simple sell signal, but the intelligent portfolio managers at places like Schwab or Fidelity are likely digging into the weeds, looking at the long-term implications. The prevailing belief about Ford for the last couple of years has been a story of a legacy giant playing catch-up. The narrative is that Ford, a titan of the internal combustion era, is lumbering under the weight of its own history, desperately trying to pivot to an electric future while being outmaneuvered by the likes of Tesla. The media loves this David versus Goliath angle, portraying Ford's EV division, Model E, as a cash-burning machine struggling to gain traction, while its traditional business, Ford Blue, is seen as a slowly melting iceberg. This expectation is that Ford is fighting a war on two fronts and winning on neither. It's a compelling story, and it's one that has kept a lid on the stock's valuation. Investors see the headlines about production cuts for the Mustang Mach-E or the F-150 Lightning and conclude that the strategy is failing. They look at the billions being poured into new battery plants and R&D, and they see a black hole of capital expenditure with an uncertain return. But here's where that common expectation collides with a much more complex reality. The deeper analysis reveals that Ford's strategy isn't just about chasing Tesla's shadow. The real story, the one that institutional investors trading through Interactive Brokers are paying close attention to, is Ford Pro, the commercial vehicles division. While the market remains obsessively focused on the consumer EV race, Ford Pro has been quietly solidifying its dominant position in the commercial van and truck market, a segment with incredibly sticky customer relationships and substantially higher profit margins. This isn't just about selling white transit vans, it's about building an entire ecosystem of software, fleet management services, and charging solutions that create a recurring revenue stream. The reality is that Ford's most valuable asset right now might not be its next electric SUV, but its entrenched relationship with small businesses, contractors, and large-scale fleet operators. These customers don't buy vehicles based on hype. They buy them based on total cost of ownership, reliability, and service, areas where Ford has a century-long head start. This part of the business provides a stable, profitable foundation that is consistently undervalued by a market fixated on the consumer EV narrative. Many self-investing individuals using Fidelity or other online investment platforms might overlook the strength of this commercial segment, focusing solely on the more publicized consumer vehicle sales figures. Let's dissect the recent stock movement more closely. Today's 6% plunge isn't happening in a vacuum. We've seen elevated trading volume, suggesting that this isn't just retail investors getting spooked. Institutional desks are repositioning. This kind of move is often tied to revised analyst ratings or sector-wide guidance adjustments. When a major bank downgrades the entire automotive sector's outlook, citing consumer spending or rising raw material costs, a stock like Ford with its high beta will feel the impact disproportionately. It's also critical to look at the options market. We've likely seen a spike in put option volume as traders buy insurance against further downside or speculate on a continued decline. Conversely, a savvy investor might see this as an opportunity to sell cash-secured puts, collecting premium on the belief that the stock will find a floor around its current level. These are the kinds of sophisticated strategies that go beyond the simple buy and sell clicks on the Robinhood app. The macroeconomic pressures are undeniable. Rising interest rates make car loans more expensive, directly impacting sales volumes for all automakers. Ford Credit, the company's financing arm, is a massive profit center, but it's also exposed to credit risks if economic conditions worsen and loan defaults begin to tick up. The stock's daily swings are a direct reflection of this tug-of-war between the company's internal strategic progress and the external economic environment it operates in. To understand where Ford is going, we need a clear picture of what the company actually is today. It's not one monolithic entity, but three distinct business units. First, there's Ford Blue, the traditional internal combustion engine. This is the cash cow. It produces the F-Series trucks, the Bronco, and the Explorer, vehicles that generate immense profits and fund the company's future. The market often dismisses this as the legacy business, but its profitability is the very engine enabling the transition. Second is Ford Model E, the electric vehicle division. This is the high-growth, high-spend part of the company. It's currently losing a significant amount of money on EVs it sells, a reality that the company has been transparent about. These losses are due to the massive upfront investment in battery technology, software development, and retooling factories. The expectation is for this division to eventually become profitable as battery costs come down and production scales up. But the timeline for that is a major point of contention among investors. Finally, and most importantly from a contrarian standpoint, is Ford Pro. As mentioned, this is the commercial division, and it's already a powerhouse of profitability. It combines ICE vehicles like the Transit van and Super Duty trucks with their increasingly electric versions, all supported by a growing suite of high-margin software and services. The integration of these three units is the core of the strategy. Ford Blue generates the cash, Model E develops the technology for the future, and Ford Pro leverages both to dominate a lucrative and often overlooked market segment. Fidelity ETFs that track the automotive industry will hold Ford, but the weighting might not fully reflect the unique strength of its commercial division. Now, let's turn to the future outlook, framing it through that lens of expectation versus reality. The market's expectation is for a long, arduous, and potentially unsuccessful transition to EVs, with intense competition from Tesla, General Motors, and a wave of international players. The fear is that Ford will be crushed between its legacy costs and the high price of reinvention. The risks are very real. Labor negotiations with the UAW are a recurring challenge and can lead to costly work stoppages. The global supply chain remains fragile. A slowdown in consumer demand for high-priced EVs could delay the path to profitability for the Model E division. If the company cannot get its EV manufacturing costs under control, the entire strategy could be in jeopardy. A retail investor managing their portfolio on SoFi or another online investing platform has to weigh these significant risks. However, the potential reality could be far brighter than this pessimistic expectation. The major catalyst for Ford is achieving scale and cost parity in its EV production. If Ford can successfully launch its next generation of EVs built on a dedicated platform with more efficient battery chemistry, the massive losses in the Model E division could shrink and eventually turn into profits. Another opportunity lies in its hybrid strategy. While some competitors went all in on pure EVs, Ford has continued to invest in hybrid powertrains, which are proving to be a popular and profitable bridge technology for consumers not yet ready to make the full leap to electric. This pragmatic approach could be a significant competitive advantage over the next 5 to 10 years. Furthermore, the continued growth and profitability of Ford Pro could provide the financial stability to weather any storms in the consumer market. Imagine a scenario where Ford's software and services revenue grows to a point where it commands a tech-like valuation multiple from Wall Street. That would completely reframe the narrative around the company. For those with a long-term horizon, perhaps managing their retirement funds in Fidelity IRAs or a Schwab Intelligent portfolio, the current depressed stock price could be seen as a compelling entry point. This brings me to a question for everyone watching. Comment below with what you believe is the biggest obstacle Ford faces in its EV transition. Is it battery costs, software development, or public charging infrastructure? In summary, the story of Ford Motor Co. is a classic case of market expectation being at odds with a much more complex operational reality. The 6% drop we're seeing today reflects the market's anxiety over the difficult and expensive road ahead for electric